Hello everyone, welcome to chapter 2 for the corporate finance. Today we're gonna review the review of accounting chapter. This is based on the foundation of financial management 18 editions by Block, Hurt and Dinelson, which is available in Prentice Hall. There are a number of learning objectives we're gonna start. Okay, the first objective we're gonna put here is that explain what an income statement measures. We call the P ratio and evaluation earnings, understand the balance sheet shows an asset and financing of those assets, explain what the statement of cash flow indicating, recognize that the depreciation provides a tax reduction and benefits that increase the cash flow. So what are the basic of financial statement? There are three of them, okay? The first one is called income statement, the second one called statement of retained earnings balance sheet. The third one is a statement as cash flow. Let's examine the first one, income statement. It is a device to measure the firm profitability. It covers a defined time period, presented in a stair-step and progressive fashion in examining profit and loss after each type of expense item deducted. We're gonna take a look at the example of table 2, income statement of Kramer Corporations. Okay, look at here in this Kramer Corporation on the charts. You have the sales, you get cost of goods sold, you got a gross profit, you got a selling and expense. Okay, and then depreciation expense. After that, operating profit before income tax. So sales minus cost of goods sold equal to gross profit minus the expense. You're gonna have earning before income taxes. And then you got an interest expense, you got an earning before tax, and then you got a tax, earning after tax, and then you got a preferred dividends here. 10,500 earnings available to common shareholders, 100,000. The common share outstanding is 50,000. So the earning per share will be $2. Excuse me. So what are the income statement? Sales minus cost of goods sold equal to gross profit. GP, gross profit minus expenses minus depreciation, we call it income before interest and taxes, called EBIT, or operating income. EBIT, earning before income tax minus interest, we call it earning before taxes, EBT. EBT minus taxes, we call it EAT, or net income. So those are the income statement logic in terms of calculations. Let's look at the return on capital. What are the return of capital? The three primary sources of capital: bondholders receive interest, preferred stockholders receive dividends, and common stockholders, which is dividends after preferred stockholders. Okay, what is earning per shares? It is interpreted in terms of number of outstanding shares. It must be paid out in dividends and retained by the company subsequent to the investment. Look at the table here. Table 2.2 is representing the statement of earnings, indicates the position of earning with the adjustment to previously reported income and any restriction on the cash dividend. For example, here you got a retained earning balance started 250,000, at any earnings available to common shareholders 100,000, and then deduct any cash dividend 50,000, and you have an ending balance of 300,000. So we're gonna look at the way of calculating the price earning ratio or earning per share. PE ratio, we call it, apply to earning per share to determine the current value of the stock. Okay, when I was an investment analyst at Nomura Securities and Morgan Grenfell and I'm still Securities, we always use PE ratio as the barometer. When we do an IPO, also we use PE ratio of the cheapest, or in terms of the valuations of the company. The lower the ratio is, the more attractive it is. It is comparable to its industry. Okay, the factor that influences the P ratio will be like earning or sales growth of the firm, risk and volatility in performance, that an equity structure of the firm, dividend and payment policy, as well as the quality of management. Okay, so we will take a look at a few examples later. What are those? For example, the Tesla price as compared to Toyota will be different, okay, because of the P ratio valuation as well, and the perception the investor will receive. Let's look at the P ratio earnings share slide. Okay, the next one, allow relative market value comparison of many companies, indicate the expectation about the future of the company. Firms with higher expected return have higher P/E ratio. That is tendency. Price-earning ratio can be confusing. Drop in earning may not match the magnitude of the fall of the earning that caused the increase in P/E ratio. We're going to look at a good example here. The P/E ratio of a selected U.S. company. For example, in 2021 here, BOA, which is Bank of America, 15. The P/E ratio of Cisco is 18. Ford Motor is DD, which is not available there. DD means the company is operating deficit and has no P/E ratio there. Okay. Intel 10. Johnson is 25. McDonald's is 32, is very high. And then S&P is 37, the average. Okay. Walmart is 21. Textron is 29. This is good to give you an example of comparison or P/E ratio of U.S. companies. What is the limitation of the income statement? The income statement has limitations in terms of loss during a given period. Is a function of variable transactions. So a holder may perceive much smaller gain or losses from the actual day-to-day operation. The flexibility in reporting transactions can result in differing measurement of income gain from the similar events or the end of the time period. Look at the second one, which is the balance sheet. Indicates what the firm owns and how assets are financed in form of liability of ownership of interest. It delineates the firm holding, obligation. It provides the pictures of a firm at a point in time, items stated in original cost basis rather than the current value. Interpretation of balance sheet item. Asset account are listed in order of liquidity, converted to cash. You get the current asset here, that item that can be converted to cash in 1 year. Marketability securities, which is the temporary investment of excess in cash. And then account receivable, it gives you allowance for bad debt and determining the anticipated collected value. Of course, you have the inventory, which is include the raw material, good in process, and finished goods. Okay, and then we look at the continue of the balance sheet items. Prepaid expenses represent the future expense that already paid for investment. A good example, prepaid insurance. That's one of the example. Okay, investment is long-term commitment of funds at least over 1 year, including such as stock, bond, investment, and other corporations. Of course, in a company, usually they have plant and equipment. They call it the original cost minus accumulated depreciation. What is the accumulated depreciation? It is the sum plus of depreciation charges on of the assets. So we look at the example of Kramer balance sheet here. We have a balance sheet here, asset based on the ascending order that we have just discussed earlier in the previous slide. Okay, from current asset, you get the cash, marketable security, and account receivable, less allowance for that, and then we have inventory, we have prepaid expense, we get the total current asset and other asset here such as investment, and then we have fixed asset that comprise of the P&E, which is plant and equipment, right? So we total it the total asset. How about the liabilities? We have all this in red, and we have stockholders also in black here. So let's look at the example of the interpretation of balance sheet item. Total assets are financed through liability or stockholders' equity. Liability is equal to represent financial obligation of the firm. Move from current liabilities due within 1 year to a long-term obligation. So liability that move from current liabilities due within 1 year to longer-term obligations. Okay, what are the short-term obligations, such as account payable, note payable, and accrued expense? These three categories. Account payable, amount owed to supplier, example. Note payable, short-term signed obligations such as to bankers and other creditors. And then accrued expense for the service provided but payment has not been made. Look at the stockholders' equity. It represents the total contribution of ownership interest of preferred common stockholders such as preferred stock, common stock, and capitalized in excess of par. So we're going to look at the table 2 for later on. Represent the cumulative earning, inception minus dividend and other adjustment. Look at the concept of value on this slide. Is the net worth or book value. Stockholders' equity is preferred stock components such as net worth. Why is market value is very important? It is important for the financial managers, securities analysts, as well as to holders to invest in the company or not. Okay. Most value based on historical as well as original cost basis. it is important how research development are handled on the balance sheet. Okay, some R&D never shown, not treated as the asset. Let's look at the example of factor differences between the share values, such as asset valuation, industry outlook, growth prospect, as well as quality management, risk of return of the expectation. We're going to look at the comparison of the market value to book value per share, January 21 here, from UPS all the way to McDonald's. The ratio to book value, look at this. Example 1, IBM, $122.94, the book value 23. So it is 5 times over the book value. UPS is so high, 25 over the book value. Oracle, 23 over the book value, 12 times over the book value. Okay, and then we have McDonald's NA, which is negative per shares here. And then PepsiCo is 14 times. Apple is 33.61 per book value. It's quite high in terms of the book value. Alright, let's look at the next one, which is statement of cash flow. It is emphasizing the critical nature of the cash flow of the firm operation. It represents cash and equivalent item easily converted into cash within 90 days. There's an advantage of current methods, which is allow matching and revenue expenses in period in which they are occur to profit measurable of the profit. Statement of cash flow, it has a disadvantage of an accrual method is adequate intentions not directed to firm actual cash flow positions. Cash flow analysis help in combating the discrepancy pace through accrual period of the accounting. Look at the from actual statement. There's 3 components of it: cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, resulted together in the changes in the cash flow. Illustration concept of cash flow here from operation. Okay, cash flow from operation, cash flow from investment, cash flow from financing. What are those in operation? It's coming from the generation of fund in normal operation, expenditure in the normal operation for the cash flow operations. And then cash flow from investing is from the sale of equipment or liquidation of long-term investment. What is the cash outflow? Like purchase of plant and equipment and long-term investment. Cash flow from financing, such as sale of bond, common stock, preferred stock, and other securities. Meanwhile, for the cash outflow will be retirement, repurchase of bonds, as well as stock and other securities, as well as payment dividends. So determining cash flow operation activities, we have to transition income from operation from accrual to cash basis. Indirect method, every item on income statement adjusted from the accrual to cash and accounting. In the indirect methods, which is more popular, net income represents a starting point, and adjustments are made to convert net income to cash flow from operation. This is the step on computing net flow operating activities using indirect methods. You got the net income plus depreciations minus increase in current asset plus decrease in current asset plus increase in current liabilities minus decrease in current liability. You got the net cash flow from operating activities. Okay, so you get this net cash flow from activities logic. This is the step here given to you. And then determine cash flow from operation activity continue here. Start with net income, recognize the depreciation, recognize the increase in current asset, recognize the decrease in current asset, recognize the increase in current liability, especially in each balance, and recognize the decrease in the current liability. So we're going to look at the balance sheet here in the year end, from year 20 to 21. You see the plant equipment here, the increase in the PPE from $1 million to $1,100,000. The depreciation also increased from 550 to 600. You see the difference here? There's an increase of total assets from 870 to $1 million. Okay. Now look at the cash flow operation activities. Net income after taxes, earning after taxes, you got 110 minus any adjustment such as depreciation, increase in account receivable, inventory, all added up of 40,000. Total cash from operation activities will be 150,500. So look at the determination of cash flow from investing activities. From this, you have a long-term investment activity, mainly plant and equipment, such as increase in investment and decrease in investment, source of funds. So you got that one. Increase in investment, you got 30,000. Increase in plant minus 100,000. Total net cash outflow for investing activities 130,000. And then financial activity applied to the sale of retirement such as bonds, common stock, preferred stock, and other corporate securities, as well as payment of cash dividend, as well as the sales firm security is source of fund. Okay, payment of dividend and repurchase here is used for the funds. We're going to look at the next table, which is the cash flow from financing. You got the increase in bond payable of 50,000. You got a preferred stock dividend paid out at 10,500. You got a common stock dividend paid out is 50,000. The total net cash flow of financing is 10,500 minus. And combining the three sections of the statement, it requires for the analysis on how to build up, and as you require adequate long-term financing profit should exist in to finance the long-term. The short-term funds may be utilized and carry out the long-term needs. Okay. So we're going to look at the next table, the depreciation statement of cash flow here in much very detail that we have discussed. You got the net income here, 110,000. Cash flow, net cash flow from operation activities is 150,500 because you got the adjustment here 40,000. And then cash flow from investing, you got 130,000 here minus from 30,000 increase in long-term securities and increase in the plant equipment, and then you get the cash flow financing activities, you got 10,500 minus. Total, you got the 10,001. So in terms of depreciation and fund cash flow, it is depreciation, as you know, it is a non-cash expense. Okay, it is a not new source of fund, but you need to add back to the net income to determine the actual amount on hand. It represents an attempt to allocate initial cost of asset over a useful life. Charging a depreciation cost does not directly influence fund movement, but rather serve as an accounting entry. Okay. Example: a comparison of accounting cash flow here, accounting cash flow, and the real cash flow here. Look at here because of the depreciation here. We add it up. Okay. Let's accounting the difference here. You can see the difference. The year 1 accounting flows and the real cash flow here. This is the year 1, year 2 accounting flows, the real cash flow here. Because you add up depreciation, because depreciation is non-cash flow. Okay. And then free cash flow is a cash flow from the expression activities such as capital expenditure and dividends. You have the capital expenditure that maintains productive capacity of a firm, as well as dividends that maintain the necessary payout for common stock and covers the preferred stock obligations. Okay, and free cash flow always used for special financing activities. Example here, income tax consideration, Corporation A, Corporation B. Cost of tax deductible expense include interest on business loan and travel expense salary. So you got a comparison of the two. One is Corporation A, 225,000. Corporation B is 300,000. Different is 75,000 here. Remaining, this is a comparison between two. Which one you see after tax, the difference between earnings are about 75,000. Corporation B is higher, option A is lower because of the tax issue. Okay. All right. Let's go into the last slide, which is the depreciation as tax shield, not new source of fund. Provide a tax shield benefit measure as the tax rate. So the CRA has a specific calculations on terms of CC depreciation calculations. So the total will the difference Corporation A and Corporation B will be 25,000. All right. Thank you, guys. So this is going to conclude our chapter 2, which is the review on accounting. So hopefully to see you soon again in chapter 3. Thank you. Bye.